So identifying supply and demand zones. Basically, you want to look at the down candles or the consolidation at the origin of a breakout or impulse move to the upside. So really you want to see large green candles leave from that level, and that's basically a demand zone. And it's the opposite for a supply zone. You want to look to the left and above price, and you want to look at the up candles or the consolidation at the origin of a breakdown or impulse move to the downside, and you want to see large red candles leave from this level. When you're choosing a zone, one of the most important factors is choosing a fresh zone. This means that it's not been tested yet. Every touch of a supply and demand zone consumes orders. This gives you a less probable chance of price bouncing from the zone. Once all orders have been consumed from the zone, price will break through. This is why we look to trade first time back, because you're getting those fresh orders. Imagine a supply and demand zone as like a tree. You know, the first time you hit it with the axe, it's going to hold pretty firm. It's not going to affect it too much. It's definitely not breaking on that first chop. But like the more you hit it over time, the thinner the tree gets. You get to a point that is so thin, and the next time you hit it, it's going to fall down. So you can kind of think of it as the same for a supply and demand zone. You know, they're basically filled with buy or sell orders, and the more time price hits the zone, the thinner it's going to get until eventually all the orders run out and price breaks through. So whenever you're marking supply and demand zones, you want to mark out the highest and lowest candle close, which is basically the base before a breakout or a breakdown. So what I like to do, as you can see here, I have this down move before the up move. I just mark out the down candles, and there are wicks on both sides, small wicks in this case, but I don't usually mark the wicks. I know some supply and demand traders do mark the wicks. I don't mark them just to keep it clean, and you usually get a reaction from the candle body itself, but you do want to take the wicks into consideration. So you can see it's the same thing as for demand and supply. You want to mark out the highest and lowest candle close to form the base at the origin of a breakout or origin of a breakdown. And I just like to use a horizontal box, so I use a blue box for demand, orange for supply. So next is the supply and demand structures, and I have examples for all of these on the next slide. So we have bullish and bearish structures. So the bullish or demand structures, you have a drop base rally, a DBR, which is a reversal pattern, and the other bullish or demand structure is a rally base rally, which is a continuation pattern, and it's the opposite for supply zones. You have a rally base drop, which is a reversal pattern, and you have a drop base drop, a continuation pattern. So let's go ahead and take a look at the examples. So here's a bullish or a demand structure. It's the drop base rally, and it's a reversal. You can see we have a drop in price, a base, and a rally. It's the same structure right here. We have the drop, the base, and the rally. We marked out the highest close up here and the lowest close down here, and you can see once price retested it, it went higher. So if you would have bought in this demand zone, you would have had a nice trade. And something I like to see as confirmation that price wants to go higher, once price tests the demand or a supply zone, it holds above it on the close. So you could see opened up here, came down, tested it, closed back above the zone, opened up and went higher. And you can see that was a great trade if you would have longed that. So that is the drop base rally. That is a reversal. And next we have a rally base rally, and this is a continuation pattern. Basically you have a rally, a base, a rally, just like it sounds. Here's that same area of price. You have a rally, a base, a rally. Once retested, price chops up and goes way higher. So those are the two bullish supply and demand structures. We have a drop base rally, which is a reversal, drop base rally, and we have a rally base rally continuation pattern, a rally base rally. So getting into the bearish or the supply structures, we have a rally base drop, which is a reversal. We have a rally, a base, and a drop. You see the same area of price over here. We have a rally, a base, a drop, and once retested, offered you a perfect short opportunity, and look what price did, it rejected. So that's a rally base drop, and that's the reversal. Now we have a drop base drop continuation pattern. We have a drop, a base, a drop, same area of price over here, drop, a base, a drop. See this tiny little candle. Look how precise that is. I mean, that would have gave you the best entry possible on this. So really these continuation patterns just allow you to get in on a trending market, more or less. This is the downtrend, retest of this supply zone. This drop base drop continues to the downside. The continuation patterns, the drop base drop and the rally base rally just let you get in on trending markets basically.